Joining me now is Shelby McFadden, the senior analyst at Motley Fool Asset Management. Shelby, welcome to the show.
Thanks for having me. Great to be here.
All right, so the Fed is widely expected to cut rates today. What are you expecting for today's decision?
You know, I have to say, and it's shocking to say this really, because I feel as though over the past 10 months I've usually said I'm expecting them to hold, but I am at this point expecting a cut, because when we look at the sort of catalyst that they've used in the recent past, they're starting to shift a little bit. They're still very much independent, that's how we would categorize them, but what they're looking at and the data that they have available to them, and the fact that there hasn't been, to their knowledge, a huge shock in a negative direction following the last cut, it's kind of an expectation that they would continue down that road, especially with employment likely, being a little bit more negative compared to where we were, let's say, 6-7 months ago. So at this point, probably expecting a cut, and I think much of the market has priced that in as well.
Yeah, I think about 100% of the market has priced it in, so they're betting on this rate cut. And then also, Jerome Powell is going to be giving a press conference at 2:30 Eastern after the decision is handed down. What are you expecting him to say?
I'm thinking he's going to be maybe a little bit tepid. Again, some of the data is missing. CPI was a bit more favorable. I don't expect him to be particularly bullish or bearish in any one direction, but probably to reiterate a lot of what we've heard from him over the past, I can't believe we're saying this now, couple of years, is that they're just going to keep watching the data. At this point, they're having to watch a lot of alternative data, private sources of data, different things that will tell us about the consumer and about the overall state of the economy. So thankfully, we do have a lot of that information from banks that's come out from earnings. So I don't expect him to be raging in any one direction. Don't expect him to be particularly political. I think he's going to be decently tepid and probably trying to quell any sort of expectations that people might have for sort of those 50 basis point cuts that I think the market's really hungry for. I think he's probably going to be trying to lead us down a path of kind of vagary so that we're a little bit more calm going into the new year, reminding everyone that the data has to speak for itself.
Yeah, and all eyes on the Fed. All eyes also on earnings. We are in the heart of Q3 earnings. We have Mag 7 companies reporting this week. What are you anticipating?
And it's interesting across the different sectors. So I think looking at the tech sector first, what everyone's looking out for is how's that capital spending going? That's something that we expect investors to really be sinking their teeth into. If expectations aren't met, then there's probably going to be consequences when it comes to valuation. We're also expecting a lot of companies to be talking about what's happening with tariffs. We are now a couple of quarters in. Most of the time we were saying we need at least 2, maybe 3 quarters to have an idea. We had companies that were working down their inventory, had a lot of workarounds for getting through that main chunk, those 2 quarters after Liberation Day. But now it should be starting to set in. So we're expecting to hear a lot more about that when it comes to companies, especially those selling tangible manufactured goods. So retail, a lot of companies closing out the quarter at the end of October, hearing a little bit more from them in the next couple of weeks. We think we're going to hear a lot more about that as well.
And what are you seeing when it comes to the state of the consumer?
Right now, they look somewhat robust. We do know that the sort of sources of cash are different, right? When we look at things like home equity lines of credit, that's increasing. People taking sort of borrowing against 401k, so they're getting cash from sort of these non-traditional places. It's financing, right? But wherever you get it, it can still be spent, and that's what we are seeing. So far, the data points to the fact that they're somewhat robust. We saw Visa earnings last night, little bit of deceleration of the growth in volumes from the U.S. consumer, but still in the upper single digits. So they're still somewhat comfortable. As I've said every year, Americans make Christmas happen. So we're going to probably still see a pop in peak. We saw from UPS earlier in the week that they're still expecting from a lot of their customers to have about a 60% increase for peak compared to the last few weeks. So there will probably still be robust looking spending through Q4.
And markets have remained resilient despite all of the uncertainty. Yesterday they closed at records for the second day in a row. How are you advising people at this time, given all of this uncertainty?
At this point, we are saying to stick to that sort of long-term focus in the investing ideology. We're not going to be able to time the market, but what we can do is spend time in the market. That allows you to make sure that you are catching those sort of upswings and not trying to avoid all of the downswings. If you stick to quality, high quality management, a sure operating system with a significant amount of operating leverage, secure competitive advantage in your industry, and great trajectory for where that business is going, you increase your odds of just being able to stay afloat in those times of storms like we're in right now. So staying invested and paying attention to the earnings calls, not necessarily trading them on any negative word, but sticking with management, understanding and being confident with where the company is going, spend time in the market. It's probably going to get you a little bit further.
And I know you mentioned Visa before, and I understand that two NYSE listed companies that you have your eye on are Walmart and Visa. What are your thoughts around them?
I mean, Visa is a toll taker, right? That's how we look at them. So even when consumers are spending less, they're still swiping their cards. Do they have a couple of competitors? Of course, in the debit and the credit space. But they are one of the top 2, 3 of the payment network processors in the US, so no matter what, money goes through those hands. When it comes to Walmart, they're sort of a sleeper cell, right? They're extremely well prepared for things like agentic AI. They have great operating leverage. Their labor model is treasured, and lots of companies try to replicate it. And then most importantly, they're making life and consumption affordable for the American consumer. So we feel like those two plays, while they may seem a little bit blue chip, these are companies that have shown themselves to be higher growth than people could have ever expected the last couple of years.
All right, great insights from Shelby McFadden, Senior Analyst at Motley Fool Asset Management. Thank you so much for joining us at the New York Stock Exchange.
Thank you.